Welcome back, folks, to my Food for Final Pincast on Chapter 3, Part 3. And in this one, I am going to look at another prepaid expense. But this time, I want to look at long-lived assets, like property, plant, and equipment. There are different circumstances with adjusting entries that relate to long-lived assets. Let me write down a problem, and then we'll look at a situation, and you can make some entries for me. Let's assume we purchased some equipment on November 1st, and the unadjusted trial balance shows $10,000 in the equipment account because of that. It was purchased November 1st, has a useful life of 3 years, and a salvage value of $1,000. We need to calculate depreciation for the month of November. The book taught you how to do a method of depreciation that you might recall is named straight line. And the formula for calculating it was to take cost, subtract salvage value, and divide that by the life of the equipment. In our example, we have $10,000 cost minus $1,000 salvage value, and this equipment will last for 3 years or 36 months. We need to record depreciation for the month of November. When you do the math, this comes up to a whopping $28, rounded. So we need to record that we used this asset, and that part of the cost, the $10,000, needs to be matched to this in expense to this period. It doesn't mean the equipment's worth more or less. It just means that we need to match $10,000 worth of cost to periods benefited, and this period was benefited by $28. We have an account on the unadjusted trial balance called equipment, and it's going to have another account on the trial balance called accumulated depreciation equipment that relates to this. It's a new account we have as of this chapter. It's a Contra Asset. The definition of a Contra Asset is an account which relates to another account that adjusts that account balance to be more correct. Well, we have $10,000 in equipment, and we need to adjust it to show we're using it through the period. These are the balance sheet accounts. The income statement account that this relates to is depreciation expense. We know how much our entry needs to be. How about you take a stab at making this entry and come back and compare it to mine? Welcome back. Notice I debited depreciation expense for the month to show that $28 worth of this equipment has been used, and that I credited accumulated depreciation for $28, showing that 1 month's depreciation has been taken. I did not credit the equipment account directly because with long-lived assets we don't do that. Why do you suppose we don't credit the equipment account directly? There are a few reasons. I'll give you a top couple. One is internal control. We always want to show that we have $10,000 worth of equipment on hand, and each year or some regular period we'll go out and verify that we have $10,000 worth of equipment on hand. If you don't take a periodic inventory, you won't own your equipment. The second reason is depreciation is an estimate, and we don't want to assume a greater degree of accuracy is happening with this account than is. Only $28 doesn't mean the equipment's worth more or less. It just means we've matched 1 month's worth of expenses against the equipment. And finally, disclosure purposes. What do I mean by disclosure? Well, let's think about what's on the balance sheet as it relates to equipment. Equipment would show up on the balance sheet as an asset in the amount of $10,000, and after 1 month we show accumulated depreciation. I abbreviated that is $28. The difference is called book value, though you won't actually see that word on the balance sheet. And in our book value at the end of 1 month is $9,972. And you can see we have equipment in the amount of $10,000, and it hasn't been used very long at all. And here's its book value. 1 year out will still show equipment having a value of $10,000, but at the end of the year we will have picked up a third of this. 10,000 minus 1,000 is 9,000, and a third of that will be 3,000. So we will have depreciated 12 months, or 12 times 28 equaling 3,000, and that will show our equipment having a book value of $7,000. You can still see we own $10,000 of equipment. It's still pretty new, and your eyes tell you that by the relationship of depreciation to the equipment, and this is a book value. 3 years out, you'll still be able to see we have $10,000 worth of equipment. By then, we will have taken 3 full years worth of depreciation. That'll be $9,000, and it'll have a book value of $1,000. So you can still see how much equipment we own. You can see how much we've written off so far, and you can see how much we have left to write off, or in this case, it's fully depreciated and down to its book value. So there's a certain amount of disclosure that comes by using a contra account to pick up the accumulated depreciation. That then is a review of prepaid expenses for long-lived assets. So let's finish up this series of 3 pencasts by saying, where did we leave Chapter 3? Well, in Chapter 3, we learned that you have a general journal where you journalize transactions that were posted into a general ledger, which left you with an unadjusted trial balance amount. We learned how to do that in Chapter 2. Then we learned that the unadjusted trial balance had some numbers on it that weren't correct, either for the passage of time or use, or that you've earned some of the amounts that are shown as unearned. Because facts and circumstances have changed, you need to make some more journal entries. All journal entries are journalized. These are called adjusting entries, and they're journalized while all journal entries are made, and that's in the general journal. They're dated the last day of the month. These then are posted into the general ledger, the place where all our financial statement accounts are. These are totaled, and an adjusted trial balance is made. The adjusted trial balance is now having clean numbers on it, ready to make financial statements for the period. We learned how to make financial statements in Chapter 2. First, we made an income statement, and you need that number to make the statement of changes in owner's equity, and you need that number to make the balance sheet. We'll be doing more with financial statements in upcoming pencasts. Right now it's important for you to know that they can be prepared and should be prepared in the accounting cycle after the adjusted trial balance. So we have journalizing, posting, trial balance, journalizing, posting, trial balance. And it's currently happening twice. So we have expanded what we know about the accounting cycle to include all these steps. Thanks for joining me, and let's move on to a review of Chapter 4.